Okay. Good evening, friends. Once again, I welcome you on behalf of the Direct Tax Committee on this virtual platform. It's a great pleasure to have all of you here once again on the topic of practical aspects of
Recording has started.
Friends, we all know that the tax audit report, the reporting by the chartered accountant as far as the tax audit was concerned was introduced in the Finance Act 2000 in 1984, and since then that was with effect from 1st April 1985. So since then we are given the responsibility of conducting the tax audit report. Again, not only it was based on the prescribed turnover, but also under some deeming provisions also, which are given in section 44 AE or 44 BB, 44 BB, 44 AD, and all those provisions are there. If you are showing the lower profits, then again tax audit was applicable. The main objective of the tax audit was to ensure that the assessee is maintaining the proper books of accounts, and we were supposed to certify those books of accounts. From the government point of view, they are interested in the tax collection, and indirectly that responsibility was given to us to ensure that the assessees are paying the taxes properly. They are also getting the revenue, and therefore in the end that there is no tax evasion or tax avoidance in the country. And therefore this big responsibility was given to us, and therefore this responsibility that has been given to us should be carried out with all due diligence and care. And therefore with this aspect keeping in mind, today the Direct Tax Committee has taken up this subject in the benefit that we should enrich our knowledge, and we have to update, because time and again the tax audit report has been keep on changing, and new reporting factors have been added, and therefore we have the Direct Tax Committee has kept this webinar for the benefit of all our members. Friends, it's a very pleasure to have today on with us T.A. Chandrasekhar Chitre sir, our own CCM from Pune, and he is also the chairman of the Direct Tax Committee. I welcome him on behalf of all of us. I also like to welcome C.A. Dr. Raj Chawla sir, who is also vice chairman of the Direct Tax Committee. On behalf of all of us, I would like to welcome you, sir. I also welcome C.A. Pramod Jain sir, who is also CCM and member of Direct Tax Committee, and welcome you, sir, on this virtual platform. I also welcome C.A. Abhay Chhajed sir, who is also vice chairman of the Taxation Audit Quality Review Board of ICI. Welcome to all of you, sir. Before we start this session, I would like to request C.A. Dr. Raj Chawla sir to give his opening remarks on this occasion. Over to you, sir.
Thank you, Chandrakant ji. Good evening to all. At the outset, I, on behalf of Chartered Accountant Institute, extend a warm welcome in this today discussion, and I also welcome C.A. C.V. Chitle sir, Chairman of Direct Tax Committee, C.A. Pramod Jain ji, our Senior Central Council member and my colleague, and C.A. Abhay Chhajed ji, a young and dynamic Central Council member, and C.A. Chandrakant Kaleji from Pune, and all the members attending this our webinar in this webcast on panel discussion on practical aspect of tax audit under Income Tax Act 1961. It is indeed a pleasure to have you all in our honored speaker panelist. I really thank you for giving time out of your busy schedule for sharing knowledge with all of us. Direct Tax Committee of ICI is a partner in nation building, has always been working towards facilitating the objective of the government, and the same time plays a pivotal role in strengthening the relationship between taxpayer and the department by bringing to the notice of department genuine hardship being faced by the assessees under the income tax law, and to ensure timely redressal of the same, and by advising and helping the stakeholder for proper and timely compliances. Our today topic of panel discussion is the practical aspect of tax audit under Income Tax Act 1961. In India, various law governs different type of audit like statutory audit, stock audit, cost audit. The core purpose of these audit is to ensure that the books of account are free from any error mentioned in the particular law. Similarly, Income Tax Act provide for tax audit under Section 44AB. Tax audit is an examination of books of account of any business or profession by a tax professional viewpoint. Tax audit under Section 44AB is an effective tool for the Income Tax Department to assist them in making assessment of assessees. After the mandatory e-filing of tax audit report, the importance of tax audit have increased tremendously. In Form 3CD is to be supplied and filed by the assessee and to be verified by the chartered accountant, that is our member. As per Section 44AB, the audit aim is to ascertain the factual veracity of the return filed and the accomplishment of other requirement as per applicable law. The chartered accountants performing the tax audit is required to do the submission of all its finding and observation in the form of an audit report. The audit report is given as per format available in the form 3CA, 3CB and 3CD. On this note, I leave it to our esteemed professionals to take the discussion forward. I hope that the participant would be benefited a lot from the today's interaction and discussion, and also it would provide an ease in implementing the topics area deliberated upon. So thank you, Kale sir.
Okay, thank you, sir, for your wonderful opening remarks given on this occasion. Without wasting much of time, I would like to hand over these sessions into the hand of CA Abhayji Sajid sir, who will be moderating the panel discussion today. Over to you, sir.
Thank you, Chandrakant ji, and thanks for the opening remarks. And highly respected Central Council member Chandrasekhar Chitle ji from Pune, CA Pramod Jain ji from Delhi, and CA Dr. Raj Chawla from Delhi. And thank you, Raj ji, for setting up the tone. I think rightly mentioned and covered that why this panel discussion on very important topic, tax audit, which is prescribed under the Income Tax Act 1961. And I think there's so much to learn and interact, discuss, and I'm sure members would really be benefited with this panel discussions we have. Just to start and quickly, I would request CA Chandrasekhar Chitle ji, who's the chairman of the Direct Tax Committee of ICI, to just give a brief, a background about what DTC has been doing for so many years and why, the Direct Tax Committee role is so important. And one of the roles, of course, is coming up with the guidance note, and I think that process is already on, which I think he's been instrumental as chairman. But I'm with his, knowledge and background, and having him as a discussion on the panel on this topic particularly would really enrich the knowledge of each participant. So over to Chitle sir for giving a brief background about the DTC committee.
Thank you, Abhayji. As we are aware that Institute functions under aegis of various committees, Direct Taxation Committee has been entrusted with the responsibility of looking after professional interest of chartered accountants in the field of direct taxes, and also the stakeholders are guided by this particular committee. In this committee, besides me, I am having CA Dr. Raj Chawla, and both of us are heading this particular committee, and members like Pramod Jain, Abhay Chajed, they are of immense help for the purpose of discharging our functions. As you know that in case of Direct Taxation Committee, before we discuss anything, let me first tell what we have done this February and last February. We have written to the Central Board of Direct Taxes that we don't want any extension for any submission of audit report, ITRs, etc. A number of SMSs and messages and mails keep on pouring in certain matters that extend the due date for ITR, extend the due date for tax audit report, etc. But we are of the firm belief that any extension is counterproductive for the professionals. Because on one hand, the time available for the purpose of work enhances, your time consumed for the purpose of discharge of those functions increases, and at the same time, there is no increase in fee. So on one hand, you find increase in expenditure, on the other hand, income remains stationary. That is one major loss which the profession witnesses. Secondly, as far as our profession is concerned, this profession is a knowledge-based profession. So supposing if 31st July is the due date for the purpose of furnishing return of income for certain class of assessees, not non-corporate assessees, not having tax audit, in that case, if that work is not accomplished by July end and it drifts on to the, say, September, October, December, then the invaluable time available for the chartered accountants to cope up with the advancement in the knowledge, with the change in law, to do some homework and prepare for better services to the stakeholders, you lose the time. And again, from July till December, you are engaged in doing routine work. So there is great loss of time and opportunity for the purpose of updating the profession. And as you will appreciate that updating holds the key for the purpose of any professional to remain relevant. So for these two reasons, we have written this to the CBDT. Not only that, but it is with a rider that you have to come out with all the forms, etc., right in the first week of or second week of April. Then only this will be possible. We believe that now gradually the CBDT has started doing this. For the purpose of uploading, there are certain difficulties. Those difficulties are being discussed with the Central Board of Direct Taxes, also with the Infosys, and these difficulties are trying to be addressed. But in respect of these practical difficulties as well as extensions, the response from the department is that now, as far as if there is a delay in furnishing of any return which is expected to be furnished, who will be at a loss? It is not a chartered accountant who will be subjected to penalty or any fee. It will be the industry which will be facing these particular consequences. So let the industry come forward and explain us what are the problems. And there we find that the response from the industry is lukewarm. So we believe that whenever there is any need for extension for any reason, I think rather than approaching ICA or DTC, you can appraise us. We definitely through our informal channels update the information with the appropriate authorities, but you tap the doors of chambers of commerce and such other institutions and ask them to represent their grievances with the Central Board of Direct Taxes. And that would be a better course of action, so that when the stakeholders themselves apply who are going to suffer, I think their petition would be listened more sympathetically. Of course, whatever drafting help, etc., is required for them, we will definitely provide inputs to the Trade, Industry and Commerce Association. That is our resolve. Direct Taxation Committee, besides organizing various programs like this webcast, seminars, conferences, we are also into publishing various publications. Abhay mentioned about tax audit guidance note, that yes, the tax audit guidance note has not been revised for quite some time, and this time we are going to revise it. The work has almost accomplished. Of course, this work is the first draft prepared at the end of Direct Taxation Committee. So those who are desirous of you, and I would appeal all of you that please go through those drafts, and if there are any suggestions, any inputs that you want to suggest for improvement of this guidance note, it is really welcome. Myself and CA Dr. Raj Chawla would personally look into those, your each and every suggestion, along with our team members Pramod and Abhay. You can send in your reaction to dtc@icai.in. Of course, those who are interested in doing this exercise, and I appeal majority of you should be interested, please send request to dtc@ici.in that you want to have this draft, so that the draft can be circulated to you, a soft copy of the draft. You may go through that draft and please offer your suggestions. Besides this publication on tax audit guidance note, we are also revising certain other publications. To start with, two publications are on hand. One is the guidance note on audit of charitable institutions under section 11, 12, 13, and taxation of charitable institution, where CA Dr. Raj Chawla's team is taking great efforts, and I'm sure that within a week's time their drafts also would be available. So those drafts also will be circulated to those who demand, and we can receive inputs from you. Now, from this year, one new era aspect of taxation has set in, and that is taxation of virtual digital assets. It's not that earlier they were scot-free of tax, but now they are more regulated. So we would like to enlighten our profession about taxation of virtual digital asset, and that publication also we are taking up. So if anybody wants to give inputs into those publications, please write to us, and we will certainly respond to your request and really take your help in improvising the quality of this particular publication. So friends, this is the, in nutshell, what the Direct Tax Committee is doing as far as the focal point for the consideration of members. As far as today's webinar is concerned, besides Direct Tax Committee, we also have Tax Audit Quality Review Board. So both these committees together have organized this today's event, and we have pleasure of presence of Vice Chairman of TAQRB, TA Abhay Chajed, former Chairman DTC, and who is expert in direct taxes, Pramod Jain, has also kindly agreed to join, so that with his particular association in this particular program, the value add in this particular segment is tremendous, and we are confident that whatever questions come up, if maybe other panelists are not able to address, we have the last lender of last resort, and that is in the form of CA Dr. Pramod Jain. So welcome Pramod Bhai for this particular seminar, and definitely the members who are the audience will be eagerly awaiting our discussion on this particular topic. Thank you.
Thank you so much, Chitleji, and I think you've enriched the members with whatever the DTC has been actively doing, and of course with your experience of so many years in the council and under in the taxation would really help. The members would really be benefited. So, and I think three guidance or the technical guide which you mentioned is so important. One, of course, is the guidance note on tax audit. The other two which you mentioned is about the taxation on charitable institution. I think that is also one, guide which members would really need, because these are institutions which are spread across India, and it is not city based. It is even smaller cities. Practicing members really get, would really need the guidance from the institute in terms of the taxation of charitable institution. And third, you mentioned about the taxation of digital asset. Again, that is, is now becoming a need of an hour, and going forward, you will have this accounting also aspect has to be taken, and even the taxation, both needs to be taken. So thank you very much for your
Abhay, since you mentioned about taxation of charitable institution, let me appraise the members that there is a section that if you do not furnish return of income on or before the due date, you lose the benefit of exemption. So that is very important aspect that we want to bring home to the audience, and therefore it is necessary that at least in case of charitable institution, we have to be before the due date, we should be furnishing the information. Otherwise, there would be a great loss to this charitable institution, and we should bring this enlightenment amongst the charitable institutions. So across the country, if anybody wants to hold seminar of charitable institution, maybe our guide will be really useful. Thank you.
Thank you. And just one last thing with respect to DTC, what you mentioned is that any issue with respect to Direct Tax Committee or any your questions, any doubt which you have, you can always send members, participants who are there today, could send an email to dtc@icai.in. I think that is, we'll sure that we have also a secretary which is there, Rudrakshi, who will be, who's also part of this webinar, and certainly if there are any issues which would be definitely responded. Thank you, Chitle sir. And now I also invite CA Pramod Jain, who is one of the panelists today, who will be responding to all the issues which members would have who are participating. And just to give you, a background of Pramod Jain, of course, an excellent speaker, and he's also the chairman of one of the most important board of ICI, which is the Accounting Standard Board, which takes care of all the accounting, whether it is Ind AS, whether it is accounting standards, or any accounting with respect to the financial statements is taken care by the Accounting Standard Board and being member of DTC, and also as a speaker, he's been very instrumental in sharing his knowledge, his experience among all the members. So I would certainly request Pramodji for his words of wisdom before we commence our panel discussion. Pramodji, please.
Thanks a lot, C. Abhay Hajarji, dear friend, and for the very kind words. In fact, we have worked together. You are leading the ASB. You are the vice chair of the Accounting Standard Board. The first time entered into this council, just like our Dr. Raj Chawla ji, who is working head to head with our chairperson of this committee, which is holding this webinar today, CA Chandrasekhar Chitle sir, though senior to me in experience, as well as the way he handles the income tax cases. I've seen him because he was earlier the chairperson of the CLCGC also. Now he's the chairperson of the Direct Tax Committee for the last 2 years, as far as I remember. Thank you, Chitle sir, for making this program happen and inviting us to share our knowledge into this point. And as Chandrakant Kaleji has always been instrumental, and he has been taking Kale Saab, he's a thorough professional on the income tax as far as I know. So he has been contributing to a great extent to the whole fraternity. Friends, just to share what Abhay sir talked about the Accounting Standard Board, and from here I like to just add about when we talk about tax audit. When we talk about tax audit, some of our friends think that tax audit means the 44 clauses of Section 40 of Form 3CD. The 44 clauses of Form 3CD, but it is not so. It is not so. When we talk about tax audit, the requirement is twofold. One, to audit the financial statements of the assessee for the period for which you are filing the ITR. So audit of the financial statement is required first, and then filling the particulars which is annexed thereto in Form 3CD. So what happens that if the audit is done under some other law for companies or LLP, we'll be discussing later. But when we are doing an audit under the Income Tax Act for the financial statements also, so here what I want to emphasize is that for when we do an audit of, say, proprietorship, partnership, LLP, when you do an audit of the financial statements, their financial statements formats were earlier not prescribed. Now, your own board, ASB, has prescribed those formats, the formats for the financial statements for non-corporates. You must have received an email, WhatsApp, social media, everywhere you have seen it was released yesterday under the able guidance of CA Abhay Hajarji. So he is the vice chair. He took very keen interest into that. And another our council member, Vishal Doshi ji, was the convener. So that format is there with you, which is nearly as good as Schedule 3, providing current year disclosures, previous year disclosures, and dividing into current and non-current assets and liabilities. So that format we all should take care that when we audit, a tax audit when we are talking about, that the financial statements which are brought before us for the audit are presented in those formats only. And my earnest request to all of you, very soon, an Excel format of these financial statements will also be uploaded on the ASB website. So my earnest request, as well as Abhay Hajarji, we both are on the ASB. Of course, our chairman Chitle sir is also there, member of ASB. All of us, that please ensure that the financial statements are in those formats, which is very, very important. Let us just, I just wanted to add that at the start of that, because tax audit again, first audit, then taxation point thereof. Thank you, Abhijit, for.
Thank you so much, Pramod.
Yeah, Abhay, only I would like to supplement Pramod that
Yes.
As far as these formats are concerned, because these accounts are to be prepared by the assessees, maybe the professional should circulate these formats to the assessees so that they will gear up for the purpose of preparatory work. Thank you.
Correct. Absolutely, sir. I think that is very important because we have come out with this, guide on non-corporate entities, and this is one sector where, different formats, different way of preparing the financial statement has been presented by the preparer and audited by us. So I think that would really help the preparer as well as the auditor, to have a discipline, and going forward, we may come up with a guidance note which would then be very it would become a mandatory formats for all the preparers as well as auditors to audit. Thank you so much, Pramodji, for your words of wisdom. And friends, just to add that since this is a program organized under the Direct Tax Committee along with the Taxation Audit Quality Review Board. Now this TAQRB board is not a very old board, is just a couple of years old. And that is, a board which has been created to review the tax audit reports, which are audited by the chartered accountants. So under the Income Tax Act 1961, wherever the audit has been done under 44AB, the tax audit report are being reviewed by Taxation Audit Quality Review Board. And, advisory has been issued to the auditors to improve the presentation, the compliances where have been missed as per the Income Tax Act or rules. So this board has been working for some time. We pick up the tax audit reports on sumo moto basis as per our random selection. We also get information from various regulators which are there like RBI, IRDA, CBDT, SEBI to pick up certain tax audit, and we send the information to the tax auditors to send us the tax audit report, which we receive. We review the tax audit based on the guidelines of the income tax, the rules thereon, and then issue an advisory. So here the important part with the Taxation Audit Quality Review Board is that if there are material non-compliances which are observed in the tax audit which is done by the chartered accountant, then the cases are being referred even to director discipline. So here you will have to be very careful. That is why I think this program and programs coming in future would be very important, where we could interact, resolve our issues, understand what are the reporting requirement under the act and the rules, and how to report so that this is well taken care. And so far as the board is concerned, these are not considered as a material non-compliance. So if there are no material non-compliance, then an advisory is issued. Also the board come up with a common irregularities or a study on non-compliances for the members, and again we are coming up very soon in 1 month's time. We have initiated the process and we'll be issuing a non-compliance on various clauses of tax audit, where we'll guide you how it has to be reported, how it has to be submitted under 44AB in the form of where we issue the form 3CV. So how the audit report is to be taken care, where it is 3CA, 3CB, how it has to be seen from standards on auditing 700, all those issues will all be taken care and would be covered in study on compliances. So this is all about the Taxation Audit Quality Review Board, and we also have Mukta Katuria, who's the secretary from the board. And if there is any issue with respect to taxation, any clarification, you can always write through us through DTC or directly to us through the email ID of Taxation Audit Quality Review Board. So this was about it, and I think thank you so much, Pramodji, Chitleji, Rajji, and Chandrakantji for sparing your time. And now we'll start with the panel discussion. I have almost 700 plus participants who are attending, and we have few questions which we have received. So I'll just quickly take up questions one by one, and I think the panelists Pramodji, Chitleji, you would respond, and you just let me know if there's anything would like me to add, or if there's anything which is still there is more clarification needed, the members could send it directly to the DTC at dtc@ici.in. So I would just go through the question answers quickly, sir. And the first question which I would like you to, one of you, of course, maybe I would start with Pramodji, that are there any compliances with respect to standards on auditing 700, SS 700, which are to be taken care of while filing tax audit report under Section 44AB of Income Tax Act. So this is the first question which I would like you to attend, Pramodji, that how do we, take care of 3CA, 3CB in terms of SS 700?
Thank you, Abhijit. Very good question. In fact, when we talk about the reporting format, when we talk about our standards on auditing, the reporting standards SS 700 series, so whether it should be included in our reporting format, which is there, our audit report format is 3CA, 3CB. 3CD is an annexure to that, which are the particulars. So if we talk about 3CA, 3CB, then it is recommended by the Direct Tax Committee as well as TAQRB. And if we see the wordings which is there as per SS 700, in my view, it should be mentioned in relation to, if I talk about Form 3CA, then at para 5 regarding the reporting for clause 3CD, because in Form 3CA we don't talk about the reporting on the financial statements. But when we talk about the financial statements also in Form 3CB, then there are two paras where we have to report. One is para 3A, second is para 5. So SS 700 reporting should be both there for tax audit report. What is the management responsibility? What is the tax auditor responsibility? For 3CA, tax auditor's responsibility and management responsibility in relation to the 3CD, particulars therein. And in Form 3CB, we have to talk about both. For the financial statements, again, the responsibility of the management and the responsibility of the auditor. And at para 5 again, for the tax audit, for the 3CD, responsibility of the management and the responsibility of the auditor. So that should be mentioned out there, which should be feeded out there. It is not about when we are filing on the website of the Income Tax Department. When we are issuing our report, it should be manually as well as that is physical copy when we give. That should also contain, and when we upload on the income tax portal, that should also contain out there. So my view is that yes, and our tax audit guidance note, even that 2014, if you see, that also clearly says that yes, SS 700, it is preferred that it should be mentioned, it should be reported out there in the relevant clauses. They've been detailedly mentioned.
Thank you so much, Pramodji. Chitli sir, just one point on this, that we issue Form 3CA, 3CB. Now the members, have a lot of issues in terms of reporting under Form 3CD, which is the annexure of these reports. Now, but there are certain important aspects which should be considered or taken care while issuing the Form 3CA and 3CB. Like, what could be the qualifications? Like maybe one or if you talk about qualifications which are missed out sometimes by members, not reported, and there are clauses where reporting is incomplete, not provided, or not able to report. So how do we, report under 3C or 3CB? Any important or few important aspects, if you could just highlight to the members?
Yeah, thank you, Abhay. To start with, I think in 3CD itself, members indiscreetly use nil and not applicable. Say, for example, the question relating to partnership, what is the profit sharing ratio, etc. So if you are reporting in case of a company, at times people write nil, but this particular question is not applicable to firms other than to entities other than partnership firms, AOP, BOI, etc. So whenever you are using these terms in Form 3CD itself, nil or not applicable, please be careful. Please read the question and then respond. Secondly, as far as various clauses are concerned, for various reasons, you want to demark your responsibility or you want to amplify what you have worked out is based on a particular presumption. So, for example, in case of question which is relating to working out of ratios. So when you are working out of ratios, you must have included certain things in gross profit. You must have included certain things in turnover. You might have excluded certain things. So there are certain presumptions on the basis of which you have worked out the ratios. In the new mechanism, which is uploading this tax audit report on income tax portal, there is no room available for the purpose of stating what presumptions you have done, what working you have done. So it is advisable that you include these particular things in Form 3CA or 3CB as the case may be. Secondly, in case of say payment exceeding rupees 10,000 otherwise than banking channels, the guidance note also recommends that if checks are not available, etc., you have to write certain notes. So whatever things on which you have certain reservation, you should put all those things in this particular form 3C and 3CB, because for the purpose of reservation, no room is available in against each clause. So you have to include everything in this particular form 3CA, as Pramod earlier said, in para 3 or para 5. While doing so, if you go clause wise, supposing say clause number 5, this is the note, clause number 7, this is the note. So for the purpose of assessing officer, it would be really convenient to refer to those clauses and relate the notes. If you write indiscreetly, then it may be difficult to reconcile. And for auditor also, whether he has included every note or not, that also will be difficult for him to reconcile. It will take some time. So maybe clause wise, if you go on reporting your reservations, it may not be qualification, it may be disclaimer, it may be amplifying your view, whatever it is, let it come in this particular format. If you distinguish between the informative notes, between the disclaimer and between the qualification, that would be better, because all notes are not necessarily qualificatory. That is number 2. Number 3, in respect of particularly, I would invite attention to reporting on ICDS. Now, a question has been asked, what the policies of for income computation and disclosure have been followed? Is there any deviation, etc.? So one has to appreciate that as far as section 44 AB is concerned, form 3CB rules are concerned, you have to report on the books of account provided by the assessee. You are auditing books of account. But section 145, etc., clearly state that these income computation and disclosure standards are inapplicable for the purpose of maintaining books of account. So how you are reporting on ICDS? Obviously, you would be asking some draft presentation, maybe draft computation from the assessee. And based on that draft computation, you would be reporting, because that is nowhere available in books of account. The normal procedure is earlier the accounts are finalized, then audit is carried out, audit report is given, and thereafter the computation is done. But here, because in audit report itself question has been asked about computation, draft computation will have to be made available by the assessee, and based on that you would be reporting. So while you are reporting on this clause relating to ICDS, in your form 3C and 3CB, you have to furnish the basis on which you are reported. If you straight away report, then a question may arise from where these figures have come. So not only you should report about this draft computation, but also you should take representation from assessee, let him sign this particular thing. So later on, if supposing something turns out to be incorrect as far as those draft computation is concerned, assessee will have to own it up. And it is also possible that whatever draft he furnishes you, maybe ultimately while he submits the return or the ITR, again there may be some different computation. Just to cite, supposing you have concluded your audit on say 15th of September, outstanding taxes were say 80 lakh rupees, and out of 80 lakh rupees, by 15th of September, assessee has paid 30 lakh rupees. So in his draft computation, he may consider disallowance 50 lakh rupees under section 43B. But if he furnishes return on 25th of September, and within those 10 days, supposing further 20 lakh rupees are paid, so obviously he will be reporting disallowance of, because out of 80 lakhs he has paid 50 lakh rupees, he will be reporting disallowance of 30 lakh rupees. So for legitimate reasons, there may be variation between what draft has been given and what is ultimately reflected in the ITR. So in order to protect yourself, it is necessary that you should include such type of, you should obtain such type of representation, and also make reference to this representation in your tax audit report. So as far as every clause is concerned, now our guidance note will also state that what precautions you have to take, what reporting you have to do, because guidance note is developed from the perspective of doing audit of accounts. and reporting under section form 3CD. So carefully go through this entire guidance note and see that your audit report is in conformity with the guidance issued by the institute. So these are principal items that I would like to state. Be careful as far as nil not applicable is concerned. Wherever you are giving notes under specific clause, because there is no room available, maybe include all those notes in paragraph number 3 in form 3CA or para 5 in form 3CB. And if you write them clause wise, it would be better. And wherever you have sought representation about particularly ICDS and such other matters, be careful that you obtain a representation letter and you make mention of this particular computation, or your reporting is based on draft computation. There are other small issues I think people can go through the publication which would be released by TAQRB, and also the guidance note that would be released by DTC. Thank you.
Here, Abhiji, Chitra sir, I would like to add just one or 2 points, taking a clue from what our chairperson has said, Chitra sir. Yes, when we talk about 3CA, para 3 and in para 5 of 3CB related to 3CD, we have to mention the observation or our comments thereon. But sometimes what was seen even by the TAQRB is that they refer in para 5 or para 3 relevant of 3CA, 3CB. Is that refer in the notes. And when you go to the notes contains everything which is not even related to even 3CD. It is not that way. Whatever needs to be given in 3CA, 3CB, it is our report. It has to relate to 3CA, 3CB or 3CD only. Point number 1. Point number 2, we have to be very careful when to issue 3CA and when to issue 3CB. Because we have seen this year, several calls have come to all of our Chartered Accountant Council members, I would say, that they had uploaded form 3CA, but in the UDIN they mentioned 3CB, 3CD. So, or vice versa. So, first of all, we have to be very clear that yes, one of the clauses, clause 8, read with 3CA, 3CB plus UDIN, they all should match. They all should match. I have to be very, very careful for generating UDIN and choosing the correct form. When to issue 3CA, when to issue 3CB, 3CD is common to both. Now, just to give you a simple example, it is not that every company would be issuing 3CA. For every company, you will be issuing 3CA. Or for LLP, we are issuing 3CB. No, the basic content everyone knows theoretically that when the audit is required under any other law, then I have to issue 3CA, otherwise 3CB. So when I am talking about audit under any other law, when it is done, then 3CA, then I have to be very sure that that audit has to be for the period for which the ITR is to be filed under any other law. For example, I'm simply saying, in the case of limited liability partnership, if there is a tax audit, I should be aware as a chartered accountant that yes, audit is required under the LLP Act, and when the audit is required under the LLP Act, then I have to issue a separate report for the LLP Act, and audit is for the financial statements is done there. Then I have to issue form 3CA for LLP. And in case let us take another case of a private limited company, say which is incorporated on say 1st of February say 2022, and there is a tax audit requirement. Now under the Companies Act, it is very clear cut that for a company, the financial year in such a case where the company is incorporated on or after 1st of January, the financial year would end next year. That is March 23, it would end for the Companies Act. So for that 1 to 2 months, there is no audit under the Companies Act. So but the ITR is to be filed, the tax audit is to be done. So for that 2 months, then when there is no audit under the Companies Act, even though it is a private limited company, the form 3CP has to be issued, and that 2 months financial statements has to be audited under the Income Tax Act. So I have to be very careful in choosing, reporting the correct form. 3CA, 3CB, and then 3CB. I just wanted to add something. Thank you.
Thank you so much, Pramod ji and Chitle ji, for your response on the. And we have number of questions which are flowing in because this is an important topic, and I think the panel discussion will have certain limit of time where we'll have to take up these questions. But I'm sure we'll have many more such interaction programs going forward because tax audit has been done at various levels, all cities of various entities. So questions would definitely be there. There's one question which I'll take up next is Form 3CD. Now we talk about clause 16, which says amounts not credited to profit and loss account being subclause D, any other item of income. So the question is which income should be shown under this subclause? Now that is one question which has been asked. So Chitle ji, if you could just highlight on that point number or clause 16, which says amount not credited to profit, which income should be covered. So any other income like salary income, which is there, not part of P&L, house property, long term, or any other sources. Because I think the members have raised that there are notices which is received from CPC and they add back all the income which is shown in this clause as business income.
Unmute कीजिएगा.
This is very peculiar phenomena, and it is noticed that amounts not credited to profit and loss account, say as you mentioned about salary, house property, income, everything they are reporting. But let us first try to understand that this audit is audit of books of account maintained by the assessee for the purpose of business. So whatever is not related to this business, if it is not included in the books of account, it is not required to be reported. Even if you are, say, including this salary, etc., in your business accounts and ultimately crediting it to the capital account of the proprietor or partner, this is not the question asked because it may be income, or how it is to be addressed we will see later on. Basically, what is expected to reported is, now as you are aware that under section 224, amount which is deducted from the salary of, say, employees on account of provident fund, on account of ESI, which is considered as income. So supposing the salary date is, say, 1st of the next month. So for the month of, say, April, you are paying salary on, say, or for the purpose of May, you are paying salary on 1st of June. So on 1st of June, you deduct the PF, ESI, etc. And maybe due date is, let us say, along with extensions, etc., is, say, 15th of May. So 15th of June. So you have to pay this Provident Fund and ESI on or before 15th day of June. So if you make payment on, say, 17th June or 28th of June, in that case, as far as section 224 is concerned, that becomes income. When you go to deduction under section 36, the section 36 states that if it is paid on or before the due date under respective law, then only it is deductible. So what happens? On one hand, it becomes your income. On the other hand, it is not deductible because you are not paid within the due date. So in such circumstances, you will find that whatever deduction has been made will not be credited to the profit and loss account, but in the parlance of income tax law, it is income. So such type of income is required to be reported in this particular clause. And there is one more clause in case of business perquisites, particularly in case of proprietorship, in case of partnership. Supposing there is a scheme, you are an electronic dealer, and the scheme says that, okay, if you accomplish, say, sale of 100 crore rupees, then maybe for a partner or a proprietor, the manufacturer would provide a Singapore visit. So this Singapore visit is fully funded by the manufacturer or the supplier of these electronic goods. In that case, if you have really been beneficiary of this particular truth, it becomes a perquisite while carrying on a business. So this perquisite is not credited to the profit and loss account because this is benefit received in kind. But really under the definition of income, particularly business income under section 28, that constitutes income, which is normally not credited to the profit and loss statement. So this type of income should be reported therein. What happens? Whatever is reported, the program in this particular clause, program obviously adds to your taxable income. So if you report the income which is like salary, house property, which is credited directly to capital account of a proprietor or maybe a partner, the machine will automatically audit. Obviously, this is incorrect interpretation by the machine. Had there been income tax officer, perhaps he would have seen whether it is reported as income from salary, income of house property, and not bothered to add. But you know, in case of machine, it is the program, and on the basis of program, it works. So where such additions have taken place, maybe there are ways to mitigate those additions. But if we want to avoid those additions, maybe you do not report such type of incomes which are directly credited to the profit and loss account. But in order to be doubly safe as far as your exposure to responsibility is concerned, in Form 3CA and Form 3CB at paragraphs 5 and 3, you may state that whatever incomes which are not pertaining to business and credited directly to the capital account of the partner or proprietor have not been reported in this particular clause. If you want to still be safer, you can say salary of say 10 lakh rupees or house property rent of so and so has not been reported. So that would complete your answer and also will not expose you to technical responsibilities because it uses the word income, not business income. So in that perspective, even if you want to protect yourself, this type of disclosure can be made in Form 3CA or 3CB. Thank you.
Thank you so much, Chitleji. And another question we have is for Pramodji. Sir, this is with respect to clause 14. You know, when we speak about the method of valuation of closing stock, which is employed in the previous year. So it's been two clause 14A and 14B where we have to report. One is the method of valuation employed. And there were certain observations that, and in fact, members have doubt that what is the method of valuation, how it has to be reported. And then if there are any deviations, then we have issues with respect to, you know, valuation, which is prescribed under 145A. So if you could just, you know, guide us through us for the reporting under clause 14.
A good question, Abhijit. In fact, when we talk about, it is talking about the method of valuation of closing stock. So the problem here comes at different places because what I perceive, what Chitre sir said, and taking a clue from that again, that what happened that initially when we talk about the notifying of Form 3CA, 3CB and 3CD, everything was left on the judgment of the auditors when they are certifying the particulars of 3CD. So we used to report, for example, the 16 clause which Chitra sir right now mentioned, any amount of not tied to the profit loss being capital receipt. So we used to write and nothing happened. But now when they are digitizing it, and now they are linking those clauses, having their own interpretations, which may be correct, which may not be correct. So that is creating certain issues. So here again, for the clause 14 which you have asked, when you talk about method of closing stock valuation, they say they have fixed line of item where they say cost or market price, whichever is lower, but it is not correct. It should be lower of cost and net realizable value. But here the assessee has no option because it is a pre-filled item. It is a pre-filled item. You have to just choose. So here I have to be very careful that if anything which is not correct out here, but I have to fill it online, then I have to mention, as rightly said by our chairperson sir, that in my 3CB, 3CA at para 5, though it is mentioned here, but actually it is so. So we have to be very careful out here. Now, talking about the valuation of closing stock, it should be given for all the items. It could be raw material, finished goods. It could be scrap, which is at NRV. So it would be different. And talking about what you said about 145A. Now, this also requirement is there since, I would say, now more than 25 years. When 145A was introduced, and accordingly, this was introduced in our 3CD itself. That valuation of inventory, exclusive method, inclusive method. Now, if I talk about my accounting standards, AS2, Ind AS2, both talks about exclusive method, that when I am recognizing my revenues and my for the purpose of AS2 and Ind AS2, it has to be for the inventories, it has to be exclusive method, where the duties are not being part of those inventories, they should be excluded and not put out here. But when I talk about 145A, it says that my sales, my turnover, my inventory should be inclusive of tax. So there is a diversion amongst AS and now 145A read with now ICDS. So ICDS also they said, but prior to ICDS itself, it was under 145A, where they said that for the purpose of determining the turnover, closing stock inventory, turnover inventories, should include all the duties, taxes paid. That was perhaps for the purpose when excise duty was made part thereof, and excise duty was said that certain decisions were there. I'm not going into detail. Now, what is to be done? That our guidance note since that time, there was a guidance note at that time how to report under 145A. And the same is again given in the guidance note existing as on date, even for the which was the revised one 2014, how to report upon this. Have a reconciliation, put that out here and give it here. Ultimately, net result in exclusive method and inclusive method would be nil. And this, even the government officers do understand. And this is given in our current guidance note at, I suppose, para 8.32 somewhere it is given. But in the new guidance note, when it would be coming, it would be still there. It would be still there. So hence I request that you go through that exclusive inclusive method, and thereby whatever the chart is there, you prepare and put out there, which we have been doing it since ages. Because actually what happened when we see that guidance note, initially that was a separate guidance note that included in the tax audit report, guidance note, that net effect is nil. So when the net effect is nil, taking plus, adding plus and minus, so we started mentioning that itself, that there is the inventories are not inclusive of duties and taxes. Yet there is no impact on profits. So give that detail and provide that.
Thank you so much. You rightly said, Pramodji, that exclusive or inclusive method of valuation has to be taken care under the taxation law, and I think the adjustment is required to be made for each item of inventory. I think that is also very specifically mentioned under the guidance note, where the auditor has to ensure that adjustment is done for each item of inventories. Chitra sir, one question which we have is with respect to clause 17, 43CA or 50C, where there is a reporting when any land or building or both is transferred during the previous year for a consideration less than value adopted or assessed. Now, can you just take us through this issue? Because we have been seeing this, there are a lot of issues and doubts of members in terms of reporting.
As far as this clauses, sections are concerned, section 50C was introduced earlier, and this particular section addresses the proliferation of black money into realty market. Earlier, the section said that okay, if there is under-reporting of any sale consideration, and in that case, the assessing officer was required to prove that there is under-reporting of consideration, and in fact, more consideration has been received. Thereafter, for the purpose of registration of immovable properties, each registering district required to publish the ready reckoner values, and stamp duty is required to be paid on that ready reckoner value. So supposing in a particular, say in case of Pune, supposing in a particular area, the rate per square feet is 10,000 rupees, which is stated in the ready reckoner value, then you have to sell at 10,000 rupees, above 10,000 rupees, or the law allows elbow room of 10%. So within that elbow room, it is possible to have a transaction. Then there is no addition to the income as far as section 50C is concerned. To illustrate, supposing when the rate as per ready reckoner is 10,000, you are selling it for say 9,000, there would be addition, because typically what people feel that okay, as far as elbow room of 10% is concerned, 10% of say 10,000 is 1,000. So 9,000 is within that elbow room, say 9,001 rupees. So no need to report. But please read carefully. It states that 10% of the transaction value. So the transaction value is 9,000 and it will be 10% of 9,000. So 9,900 is the maximum. And if the ready reckoner value is 10,000, then there is going to be an addition. So this is whole mechanism. Now, in order to understand whether any such income which has escaped the reporting, which has escaped the taxation, a tax auditor has been inquired that what is the transaction value. You consider, supposing transaction value is 9,000, what is the ready reckoner value for the purpose of registration? It is 10,000. Then in that case, it is about 10% of transaction value. So you will have to report both these values of transaction as far as this particular clause is concerned. Now for this year, because of pandemic, some more elbow room was given of 20%. Therefore, they have asked whether that particular clause is applicable, so that if 20% variation is there, maybe the machine or the assessing officer will consider that. So this is required to be reported in 50C when the assessee who has transferred this asset has held it as a capital asset. However, if the assessee who is, say, a builder or who is trading in immovable property, in that case, he will be holding it as a stock in trade. So, to address this issue, qua stock in trade, you have to report it under section 43 CA. So, this is required to be reported. Now, under both these clauses, there is one proviso that it is possible that in a particular locality you have predetermined rate of 10,000 rupees per square feet. But supposing a particular area is near the slum area, or it is having certain problems, or the condition of that premises is not appropriate, etc., or maybe high tension wire is cutting across the plot, and therefore construction is not possible up to the available capacity. For such individualistic reason in respect of that particular area or that particular flat, maybe the fair market price would be lower than the price which is recommended in this particular ready reckoner value. So an option has been given to the assessee that in such case, maybe if the fair market value is lower than the this ready reckoner value, then you have to compare fair market value and the transaction value. Of course, when you report it, income tax department refers it to its own valuer, and that departmental valuer has to confirm this particular valuation. In that case, the addition doesn't take place. So, supposing the ready reckoner value is 10,000, you have sold it for say 8,500 rupees, and in that particular locality, because of certain limitation, the fair market value is 9,000. In that case, it is within the elbow room of 10%, so addition may not happen. However, if you look at the question is not addressing this second aspect of what is the fair market value. Question is merely asking you what is the transaction value and what is the ready reckoner value, and you have to restrict your reporting to that. You are not required to consider whether what is the fair market value. So if there is any deficiency, you will have to report. Maybe the machine will make addition, but the assessee will have to use other mechanism for the purpose of redressal of grievance if at all addition is made and that is not justified. And earlier you asked the question, income not credited to profit and loss account. So here, if the seller is a builder, he has sold that apartment for say 9,000 rupees, where the ready reckoner value is 10,000. As per section 28 read with section 43 CA, this amount of rupees 1,000 per square feet will not be credited to the profit and loss account. So such type of income also may require reporting and under that particular clause. But if for this purpose you have this valuation certificate available saying that okay, the market value is 9,000 or say 9,500, then it comes within the elbow room of 10%. In that case, you need not report into that clause which says that any other income not credited to the profit and loss account, because after reading the entire section, you believe that the addition is not warranted. Thank you.
A good question.
Yeah.
What you just said. A small question to you on this. Now, suppose a person has sold a property at 1 crore rupees, and the stamp duty value was say 70 lakh rupees. So that would be reported both at 16 as well as 17.
No, you are talking about other way around. Ready reckoner value 1 crore and transaction value 70 lakhs.
Yeah.
So it will require reporting at both ends, because that is the income. Exactly. Only my recommendation would be in form 3CA and 3CB. You mentioned that these are the same values reported under both the clauses. Otherwise, there will be addition of 60 lakh rupees. The double jeopardy there may be there. And I believe that
Correct.
even after reporting also, there will be double jeopardy because machine will not read the clauses and form 3CA, 3CB.
Represent DTC को इसमें. Just one point to add. Just one point to add. Whatever is there in the books of accounts, that is to be reported. In case of proprietorship concerns, where the proprietor has sold his property which is not in the books of accounts, his personal residential property and others which is not in the books of accounts, though it is there, the mind in the mind of the auditor, it could be that I am filing his ITR, so I know about it, but no. So it has to be reported only for the books of accounts. His personal property which he has sold, it is not to be reported here. Please take care. Well, Chitra sir has already said in the initial comments that only about the books I have to mention.
And this will be what Pramod has said is more relevant, particularly in case of deductions under Chapter 6A as well.
Yes,
because
yes.
there is upper limit for ATTTA, etc. He may be having personal interest in personal, he may be having interest in books of account. So you have to be careful. Whatever amount, if it is within the elbow room of say 50,000, 10,000, you can report it. But with a caveat that this is only based on books of account, not considering the other income.
Thank you so much, Pramodji, Chitleji. Pramodji, then another question I have for you, which says, is there any violation of Section 269 ST if a partner brings capital in the firm in cash exceeding rupees 10 lakhs in a year, wherein each occasion cash deposit in capital account is less than 2 lakhs? This is a question, one of the questions which has been raised.
A good question. This has come a few times earlier also to various of our members. In this case, in my view, has to be that each transaction is separate. So in the whole year, it could be 10 lakhs or whatever you say, but each transaction in a day should be less than 2 lakhs so that it is not violating 269 ST and not reportable in my 3CD2. So each transaction less than 2 lakhs, no 269 ST applicability in mind.
Okay. Thank you. Chitleji, just one question for you with respect to depreciation. You know, there's a clause 18 under 3CD, you know, if there are certain, of course, this question just came into my mind and I thought maybe I'll raise it to you. But there are certain points with respect to, you know, the each asset or block of asset, there are issues in terms of, you know, how it has to be reported, how the additions, the block, the class of assets, and there are issues with respect to reporting under depreciation. So with your experience, anything would like to, you know, raise certain, some of your observation or experience to the members or would like to highlight on this clause?
As far as this particular year is concerned, as you know that in earlier year there was amendment to depreciation available on intangible asset, namely goodwill. So one will have to really report this year. If at all your intangible asset block includes goodwill, you'll have to weed out that goodwill, and this particular clause has made room for the purpose of this goodwill. Coming to actual cost, one will have to refer to section 43, where the definition of actual cost has been provided. Again, like in section 48.3, wherever you are incurring expenditure in excess of 10,000 rupees otherwise than through banking channels, it does not qualify for deduction. However, this particular section is not applicable for capital assets. But now they have incorporated this particular provision within section 43 for the purpose of definition of actual cost. So there also you will have to consider whether this particular all transactions leading to addition to capital asset are in excess of 10,000, then they are in through banking channels. Again, typically what happens if the asset is put to use on 1st October, then in that case you tend to consider that it is for less than 6 months. So let us consider only 50% of depreciation. But mind you, in section, the section does not say that if it is used for less than 6 months. If it is, it says that if it is used for less than 183 days. So even if you put to use on 1st of October, it does qualify for 100% depreciation and not 50% depreciation. But whenever there is such an elbow room of cutoff, say just 1 day or 2 day prior to a cutoff of 180 day, the auditor should be extra careful in establishing that in fact it was put to use on 1st of October and not 5th of October. Because in that case, it would be within 183 days. And the onus will lie on auditor that how did he ascertain that, okay, it was really put to use on 1st of October. So care has to be taken in this particular behalf. Again, in case of this assets, wherever the benefit of set-off of GST is received, that is not to be considered as part of actual cost. Now section 224, the definition of income, it takes into its sweep subsidy received as income. There are two types of subsidies. One is subsidies which are in order to finance the fixed assets like solar assets, because you are acquiring solar asset and maybe some 10%, 20% subsidy is given. So this subsidy is directly to subsidize the cost of that particular asset. So if you are acquiring solar asset for 10 lakh rupees, you get subsidy of 1 lakh rupee. This subsidy, although under section 224, it relates to, it can be considered as income, but because of mechanism of section 43, it will have to be weeded out from the cost of fixed assets and it need not be reported as income when it is received. There are certain subsidies which are allowed because you have set up your factory production center in backward area, and the measure for the purpose of imparting this subsidy is investment in fixed assets. So in this case, the reason for giving subsidy is upliftment of backward area, and an industry has been set up in backward area. As far as investment in fixed asset is concerned, that is only used to measure the benefit. So this subsidy is not to subsidize the cost of fixed assets. So in this case, such backward area subsidies will have to be reported as income and cannot be adjusted against cost of fixed assets. Besides, wherever there is addition to fixed assets, you have to report each and every fixed assets, the cost, the date of acquisition and the date put to use. So here, although the concept is of block of assets, one will have to go by individual assets reporting whenever there is addition to fixed assets. Similarly, whenever you are discarding any, transferring any fixed asset, whatever sale proceeds are there, they will have to reduce from your gross block. And if then gross block turns negative, it will be considered as your short-term capital gain. So this law will have to be considered while ascertaining the amount of depreciation. And here you are expected to work out the depreciation. There is one confusion that if you refer to subsection 2 of section 32, it says that depreciation which is not allowed in an earlier year becomes a part of current year. So supposing, let us say that you have only one asset and that value of one asset, last year it was 1 crore rupees. You were allowed depreciation at 15%. So 15 lakh is the depreciation. So out of 15 lakh rupees, because of want of profits, 5 lakh depreciation was allowed, but 10 lakhs could not be allowed. And now on 85%, again, or let us say the rate is 20%, so it is 80 lakhs. Out of 80 lakhs, 5 lakhs you claim, 15 lakhs you could not claim. From 80 lakhs, again you are going to claim 20%, so 16 lakhs. Now, when you calculate the depreciation allowance, the current year depreciation will be 16 lakhs, which is 20% of the written down value, as well as the 15 lakh rupees, which is not allowed to be, which is not allowed in earlier year. So 31 lakh rupee would be the depreciation allowance. But as far as this particular question is concerned, I believe that one has to calculate depreciation available under section 32(1). So 16 lakhs would be reported, and whatever depreciation is there, which remains disallowed because of want of profits, that should not be reported. For the purpose of considering opening WDV, typically people take whatever is available in the last year's tax audit report and they proceed with that. If you consider the wording, it says that depreciation claim, depreciation allowed. So claim is really made in the return of income. So for the purpose of taking opening WDV, one should consider the depreciation schedule which is made basis of return of income and not the tax audit report of earlier year. Because if there is any variation, ultimately the claim has been tendered through ITR So we have to consider what is the closing WDV as per ITR and then take it as opening WDV. By way of abundant caution, maybe in 3CA, 3CB, para 35, one may state that we have based our opening WDV on the ITR which has been uploaded under acknowledgement number so and so. I think these are the major things I think one will have to consider while ascertaining what depreciation allowance for current year is available.
Sir, very rightly, you have brought in so many points which I think members may not be aware the various points which you have brought in.
Fully correct.
Just to add that what you told about this GST which is not allowable, members should also take care of the exchange fluctuations. They might miss out on the capital assets as per 43A. So that should also be taken care of. And also it is seen sometimes that the assessee puts the date of acquisition and date of use, which Professor said, that it is same for all the assets. Sometimes you're constructing a building, you are repairing, and you are putting the same date for date of acquisition and date to put to use. It may not be same. Or in certain cases, what is done that whole one date is put, say 30th of September for all the additions. It is not the correct. Please take care. Please take care. It is true and correct which the chartered accountant is certifying. So once he is saying true and correct, then what he is certifying is not correct. So he has to take care. Now, one point more, just to add a bit of, I would say, a discussion mode on where suppose assessee has purchased a flat. Say he purchased a commercial complex in a unit, say unit 604 at ABC complex, and using it as office. So depreciation is allowable. Suppose he has acquired that for 2 crore rupees in the city of Pune. So when he has acquired that for 2 crore rupees and using as the business, so depreciation is allowable. You will put out here. Now the question is, will the depreciation would be allowed on the whole 2 crores? Because that is a flat. But if I talk about that 2 crores is not my building cost, it includes my land value. It includes my land value. So land value in such case, in my view, should be segregated from the construction, the building value. There are various ways to do it. Otherwise, what we are saying is that on the land value also depreciation is allowable, and then we are certifying true and correct. So again, a lot of discussion has happened over the years, but this is my view. Chitra sir, your view on that, please.
Yes, I think Bombay High Court has a direct judgment in case of Citibank that whenever you are acquiring a flat or an apartment, you are acquiring land as well as building, and depreciation restricts for building. So you should get this valuation segregated between building and land, and accordingly work out the depreciation. And also it applies to capital gain as well, because when you sell as a composite, there also you have to segregate. Building portion will be reduced from block of assets and land will go for long-term or short-term capital gain.
Very rightly, sir. Thank you very much.
Thank you so much, Chitra sir, Pramodji. And now next question to Pramodji sir. This is maybe an interesting question, and a lot of members have doubts with respect to this. Private limited company having turnover of 1 crore, between 1 crore to 10 crore, having cash transactions less than 5% as provided in 44 AB, does tax audit is applicable? Department is sending notices, report is not filed.
First of all, let us understand this very, very clearly, that merely when the department is sending a notice, that doesn't make the law. I have to go as per section 44 AB, and here in this case 44 ABA, the proviso thereof. Now, if my turnover is less than 10 crores and my cash receipts, the aggregate of the cash receipts, the aggregate of the cash payments, the cash portion is less than 5% of the total receipts and payments, then there is no requirement under section 44 AB to get it audited. No requirement. There is a computerized system. Now, the problem could be that when the person is filing the ITR, in the audit information, he is selecting a wrong tick, where he says that the cash portion is more than 5%. Where it is not, where it is less than 5%, so he has to be very carefully Filing is ITR saying that it is less than 5%. So that language in that audit information in the ITR is a bit tricky. Kindly check it properly while filing of the ITR. But the law is clear. In this case, no audit required. Kindly check the ITR. Some wrong take has been done. That's why the notice has been.
Only one small addition I would like to make. Here, if
Yes.
you read the clause, it says aggregate receipts, including sales turnover. So earlier, Abhay, you asked about partner introducing some money. So in
Right.
partnership firm, that capital also is considered as aggregate receipt. So that also needs to, you need not restrict to whatever receipts to credited to P&L. Even if you have sold capital asset for say 10 crore rupees and your reported gain is 1 crore, 1 crore will hit profit and loss account. But aggregate receipt addition would be 10 crore, not 1 crore. So these aspects need to be considered. And again, while considering 5% also, all receipts will be considered, not only receipts relating to profit and loss. So supposing you have, say, in profit and loss account, receipts of 10 crore rupees, and your receipt, say, 1 crore rupees are, in case of business, you have received through otherwise than banking channels. But you have also issued debentures of, say, 20 crore rupees. In that case, 30 crore rupees are the receipt and 1 crore is within 5% elbow room. So that you will have to consider.
Yes, very right. Very rightly pointed out. Very right. It could be there. Very rightly said 10 crore sales and zero receipt, all are debtors. It could be.
Correct, correct. So Chitra sir, next question to you. This is with an important, I think this has been carried forward for few years, and this is clause 44. You know, whether to report in clause 44, I think that the members that would definitely need clarity, including me. That clause 44 relating to breakup of total expenditure of entities registered or not registered under GST for assessment year. So whether now will it be applicable for financial year 21-22 or it's still is on hold. So I think that clarity everybody participating would need.
Yeah, actually there are two clauses. One is this and one is another is asking about impermissible transactions. Let me first answer this question which will be equally applicable to impermissible transaction. I will also amplify that aspect separately. When we were revising this particular tax audit guidance note, it was noticed that the schema was furnished for this particular assessment year 2022-23, and in this particular schema, it also said that this particular clause is inapplicable till 31st March 2022. Circular was issued 2 years ago in the wake of pandemic, and this particular circular continues. No new circular or clarification has been issued. Earlier, when the schema was furnished, both these clauses 44 and the clause permissible transactions, the boxes were not opening. So at that time, the impression was that 31st March 2022 means till the financial year ended 31st March 2022, you are not required to be reported under both these clauses. But recently it is noticed that now these boxes are opening and there is no clarification forthcoming from CBDT, any renewal that whether it means financial year or it means assessment year. So by DTC, we have raised this question to the Central Board of Direct Taxes. Kindly amplify or clarify what do you mean. But pending clarification at the moment, I believe personally that since the boxes are opening and since under income tax law, whenever any date is mentioned, say 1st April 2021, that always means assessment year 21-22 and not the financial year 21-22. And as far as rules are concerned, it says that don't report till 31st March 2022. Obviously, it may mean that all reports which are required to be uploaded before that date are governed by this particular clause. So maybe for the 21 March ending, you are allowed to report maybe belatedly till that particular date. So that may come into the sweep, and for this particular year, both the clauses are applicable. Now, let us go into the reasoning why these clauses were not made inapplicable. Firstly, as far as GST is concerned, the annual data of GST is not available by the time of conclusion of tax audit report due date, because tax audit report due date is say 30th of September if you consider 1 month prior to furnishing of return of income. And as far as GST audit is concerned, it goes to say subsequent years January ending. So since there is availability of this information relating to GST after the due date for the purpose of tax audit, authentic information about the annual turnover, etc., is not available. That was one major reason that it was asked to be postponed. As far as this impermissible transaction clause is concerned, various agreements are made, transactions are made, and out of those transactions, it says that because of for avoiding taxes, if certain transactions are made, those transactions are impermissible. So substance over the form will be ignored. In substance, if the transaction is or the agreement is of the kind that it is leaning towards avoidance of tax, then this particular element of avoidance of tax will be ignored and this particular income will be brought to tax. Now, if you refer to any clauses in tax audit report, you are reporting facts. You are not expressing any opinion. Take example of section 48(2), where you are reporting transactions with associated enterprises. Now, in case of associated enterprises, transactions are not barred. They are permissible. Only expenditure to the elbow room of reasonable expenditure is allowed. To the extent it is unreasonable, it is not allowed. And chartered accountant is not asked to certify what is that component of unreasonable expenditure. What they are expecting is list of all payments made to associated enterprises. Then it is for the assessing authority to determine whether there is any component of unreasonable expenditure, and then maybe to that extent it will be disallowed. So all other clauses are centering around giving facts. Here you have to take a call whether this particular transaction or contract is tainted with the ulterior motive. So here you have to express an opinion, and which I believe is not expected of a chartered accountant, because opinions may be subjective. Maybe some person may consider that okay, it is trying to avoid tax. Some person may so it is in normal course of business. So opinions may vary, and here opinion cannot be correct. It is ultimately my opinion. Whether it is correct or not, time will decide, or every reader has to take a call. Some reasoning is provided for that opinion. So when opinion is solicited, it cannot be true and fair view. It is to the best of my information, I have rendered the opinion. So maybe these were two major reasons that these clauses were kept on hold. Soon we will receive clarification, and then certain more light can be thrown on these particular aspects. Maybe Pramod, if you want to add.
No, sir, you have very beautifully explained. And just to add, for 44, at that time when it was introduced, there was no MOU between the CBIC and the CBDT to share the data. So they were not having the data. Now they are having the data. So practically should not be there. But as you've already said that DTC is representing, so that is quite fair.
Thank you, Chitleji, Pramodji, and I think we have so many questions flowing in, but I believe due to paucity of time, we would request the members that they can always share if there's any question which is unattended, can be sent to dtc@ici.in so that it can be responded by the team under leadership of Chitleji, and we'll ensure it is sent immediately or by end of or in the next week. And then when we have subsequent programs, of course, we'll have members would definitely be able to clarify more issues, whatever they have. So next question, Chitleji, on I'll just take up on you itself again. Now, this is with respect to disallowance under section 43B reported in 3CD and added in ITR is again added back by department under section 143(1). So what is the exact reporting parameter if there is anything which is unreported or wrongly reported by the auditor? If you could highlight on this issue of one of the members who have raised.
So in fact, what I have seen is this appears to be an error in program which is introduced by the Income Tax Department for prima facie assessment, say under section 143(1). Now, if there is, say, GST of 1 crore rupees, out of which till the due date for on 31st day of March, say 3 crore rupees is outstanding, aggregate is 10 crore rupees expenditure and 3 crore rupees is outstanding. So a question required to be reported under 43B is what is the outstanding at the year ending date, and then what amount is paid from the year ending date till the due date of furnishing of return. Obviously, when you are doing tax audit, you can't wait till furnishing of return. You have to report till the due date, till the date you sign the audit report. So between this period, supposing out of these 3 crore rupees outstanding on 31st March, 2 crore rupees are paid by the entity. So realistically, disallowance would be only 1 crore, and assessees are reporting that disallowance of 1 crore rupees. But this machine adjustment is happening for entire 3 crore rupees. So it is not only addition is unwarranted, but to the extent of 1 crore rupees, it is double addition. Assessee has also added 1 crore, and out of 3 crore, you are also adding 1 crore rupees. So this is an error as far as this programming is concerned. Now, for each and every aspect, at times it is expected that we should represent and get the redressal done. But let me tell you that, okay, if such addition is there, there is mechanism of maybe rectification application, maybe you can prefer appeal, or maybe you can do both, and then get the particular thing corrected. Why small and medium practitioners are complaining and big practitioners are not complaining? I have observed that against each 154 and appeal, big firms are charging fees. And even if supposing it is like outsourcing of worries, if department has done wrong, what is mistake of a chartered accountant? They have asked what is the outstanding. Outstanding was 3 crore, so he has reported 3 crore. If 2 crores are paid, he has reported. 1 crore outstanding, he has reported. So there is no fault on the part of assessee. So if the fault is on the part of income tax department, let the assessee get it clarified, or let the chartered accountant or the consultant follow the process of 154 and 43 and appeal under section 246A. The thing is that small and medium practitioners have a package deal, and therefore if the workload increases, they feel frustrated, but they have to change the mechanism, and time is the thing which they are selling. So if this is particular error happening at the end of department, your time extension extends beyond whatever was anticipated. So for that extended time limit, you should seek additional compensation. I think that is the way you should go forward. No doubt, we point out this to the Central Board of Direct Taxes. But if it is not attended, then it is not that this is something which is not going to be addressed for lifelong. So this is my viewpoint. Whatever reporting is there, we are correct. 3CD, there is a correct reporting. There appears to be error in the processing by the machine.
Okay. Pramodji, just thank you so much, Chitleji, for clarifying and making the members understand and the reporting requirement. And Pramodji, just on clause 27A, one of the questions which been asked is in terms of reporting for amount of SENVET and ITC availed. Now there are issues with respect to amount availed or utilized during the previous year and its treatment in profit and loss account. So there are no sometimes proper reporting done. Sometimes they did not mention the SENVET which is utilized, while some miss reporting the profit and loss account, or the treatment and P&L was reported, but treatment in the account opening, closing, SENVET, ITC was not reported. So if you could just clarify on these issues in terms of reporting, what members should keep it in mind.
Well, this issue is there since 2000 assessment year 2018-19. If we see Form 3CD, pursuant to applicability of GST, the Form 3CD was amended, I suppose, twice. But this clause, if I talk about clause 27A, the notified 3CD, if you say, it does not include the ITC input tax credit. It still talks about the SENVAT only. It does not talk about the input tax credit of the GST. However, if you go for the schema or the online filing, there the wording is different, and there they have included the word ITC. But what is the law? Income tax department has got various websites. Two among them is, one is that incometaxindia.gov.in, where the notified form 3CD is there. You kindly go check the form 3CD, this clause 27A, it still talks about SENVAT only and not ITC. And you go for the income tax, the e-filing website, there it includes ITC. That has been represented a few times even by the direct tax committee to the CBDT. But it seems that if you see this form which is done by the DG systems, and the notification of the forms is by at the central level CBDT. Again, DG systems is also central level, but the offices are different. So they might have amended it without having a concurrence with the CBDT officials, because Form 3CD has been amended a few times thereafter, but they have not amended this clause specifically, even after ICI has told. So in my view, if you don't even give that GST input tax credit, there is no harm, because as per the notified Form 3CD, ITC is not required to be given. Chile sir, your view please.
Pramod bhai, I fully endorse your views. Only what happens in case of the 3CD which is uploaded, it includes these wordings input credit. So if at all you are taking the view which you are there, and I'm sure that this view is correct, I would recommend that in Form 3C and 3CB, one should mention that I have reported based on the form appearing the rules and not appearing in the schema. So then it would be better for him to address.
Agree.
And on similar lines, there are two other questions, question number 38 and 39. They also talk about audit under this SENVAT, etc. and audit under this section 72A of Finance Act, that is service tax. So there also under this schema, they are also referring to GST audit. So as far as section clause 38 is concerned, in schema GST audit is getting covered. So if you wish not to report, you can write a note. But as far as 72A is concerned, now that is clearly relating to service tax. So it will be not reported, because in both the cases, that as the guidance note reads and as is expected, that audit should be for the year under tax audit. So for the year under tax audit, there is no service tax. So obviously clause 39 is now redundant. It needs to be omitted. It has remained here. And as far as clause 38 is concerned, that is I may not say that is redundant, because even excise duty is not there. But because in schema they have included this reference of GST, I believe that if you wish not to report, maybe you can report accordingly. But for GST, if the financial year is 21-22, I am sure that no audit will take place till your tax audit. So even if you want to take a call and report that okay, no GST audit was taken, it's okay.
But Chairman sir, for the excise duty, even currently liquor and petrol.
Excise duty for certain items, petrol, alcohol is there. So
Correct.
that clause is not entirely redundant, partly redundant.
Thank you so much, sir. Chitleji, just one question for you. Next is, it talks about succession dissolution of business in case of partnership in between the year. How to compute depreciation for IT purposes for respective periods? So this is one of the questions raised by a member.
See, as far as dissolution is concerned, it is on a different footing, because at the year ending date, there will be no asset after dissolution, because there is no partnership. As far as succession is concerned, the succeeding firm will get depreciation for part of the year, and former firm will get for part of the year, and that law has been explained in the matter relating to succession itself.
Here, I'd just like to add one thing. Maybe the question is a bit unclear. If there is a partnership firm and that is dissolved and taken over and run by a proprietor, so that is a separate SSC, and that is otherwise then by on account of succession. So in that case, there would be, I suppose, a proportionate depreciation. Otherwise, then by death it is there, so it is more proportionate. But suppose there is a partnership firm, 1, 2, 3 partners are there, one retires, second continues, the firm continues, then the assessment of the firm is only single, so the depreciation would be there for the whole year, and accordingly, what I perceive.
Succession can be another thing. Supposing if the one firm is succeeded by another firm by takeover, then the depreciation
तो
will
ऐसा
vary.
होता
But
नहीं
if
क्या
it is only reconstitution of the firm, then firm remains the same. Yeah. I think they asked about succession. In reconstitution,
Correct.
firm will be same. Succession will not.
Dissolution and succession, correct.
Yes.
So Pramodji, thank you so much, Chitleji. Pramodji, one question for you with respect to, in under clause 40, when we calculate ratios, now we have to give ratio as net profit. What is the net profit to be considered? So I think your experience and guidance would be required to members that when they compute the ratios under this clause, I think there is some misunderstanding of, how to turnover definition, what to be considered. Net profit is before tax, after tax. There are certain, in terms of ratio of material consumed, finished goods produced, which are even missed in reporting sometimes, what members don't follow. So I think your guidance on this.
If I talk about the clause 40 ratios, Chitra sir in his initial comments also talked about it, that ratios we have to be very careful. And here if I talk about, in case because what sometimes happens that what you say, what is the activity in which the assessees, you say it is a trading or manufacturing concern, and then you say the cost of consumed goods, that ratio is not, we are not giving. So it is not that way we have to give. And when we talk about turnover, our guidance note says that sale of scrap should be part of the turnover, and sometimes the assessee is not including that. So we should include that in the cost of the turnover. And another important point is that what our guidance note says, that in case the assessee is not into manufacturing or trading and purely into service or financial sector, like say professional activities like chartered accountants. So in that case, because we are neither in trading nor in manufacturing, then this clause per se is not applicable. Then those items should not be given. The items should not be given. This is our guidance note says, and guidance note is a Bible for us. So whatever we say, we have to follow.
I would only like to add one thing, that whenever we use any term in rules or in form which is defined somewhere in law, we will have to consider meaning of that term as per law. Now turnover is the term employed, and fortunately for us, turnover is also described in section 145A. It says that for the purpose of determination of income chargeable under the head profits and gains, this is the meaning of turnover, which is inclusive meaning. If supposing your sales are 100 crore rupees, you are charged 18% GST. Turnover is 118 crore and not 100 crore. Now, what common mistake is made is that ratios are calculated with reference to the amounts appearing in profit and loss statement. It is 100 crore, and if your profit is 10 crore, maybe 10%. But I believe that Pramod also can give his views that really, if you want to talk of turnover, the turnover is 118 crore and not 100 crore. So maybe to that extent, ratio will make a difference. Of course, even if there is erroneous reporting, to the extent it is correct or not correct, there may be debate, but there is no definitely intention to evade the taxes. So maybe backlash would be
Sir, here, let me at least on one point have a different view from you out here. Because if I talk about section 145A, that is not for reporting, that is only, in my view, personal view, that is only for the computation of the income. And for the computation of income and not even determining the turnover for the purpose of tax audit. So here if I talk about the turnover, here it is to be reported only as, I would say, the turnover, gross receipt, the turnover and other ratios. In my view here, it is not for the purpose of computation of income. So in my view here, the turnover should be same, which is there in my profit loss account. Only for the purpose of computation, section 145A says that you have to include the taxes. My personal view, sir. We can have a different view.
Even if any view is taken, we would believe that in form 3C and 3CB, if one amplifies, maybe views may be different, but in there may be unanimity.
Right, sir.
Thank you
Sir,
so much.
this is the
No, I
benefit
know.
that when we are having a panel discussion, so different views are there and members are benefited out of the different views. So at least they are aware, all are chartered accountants, so they are aware, okay, what could be the points.
Absolutely. Thank you so much. Chitli sir, just another question to you is with respect to the revised tax audit report. No, we had instances in past and the auditors had to revise the tax audit report electronically. Now we know that as per that should be revised as per the SAS 560, which is subsequent events as revised by the ICI. Now, there could be reason that revision of accounts is after adoption in AGM or because of change in law or any change in interpretation. There is reasons which is, which makes the auditor to revise. So, what what points should be kept in mind, or what important points should be considered while revising the tax audit report?
I would bifurcate this revision of tax audit report for 3 reasons. One is there is some revision in figures in balance sheet, and that's why you are revising the tax audit report. So that's why you are revising the accounts and revising the computation of income. But revision in accounts and revision in computation of income does not necessarily follow that you have to revise tax audit report as well. Maybe if you have missed on some entries, etc., which were relevant, either you may incorporate them in books of account and then file a revised return without tax audit getting revised. So it is not necessary that in all cases tax audit report is required to be revised. Say, for example, in case of fixed deposits, till the time you finalized, by some reason or the other, you missed out on accrued interest, and then you realize that there is an accrued interest, so you revise your accounts and incorporated it. So this revision is limited to only adoption of accrued interest. So it may not be necessary that you revise the tax audit report, or there has been some error in considering some figure that you have rectified the error. So each aspect is not calling for revision in tax audit report. Even revised return can be furnished by giving reasons what was the error or what was the omission, and you can furnish the report. If at all assessing officer wants further amplification, he may seek it from the auditor. Secondly, where it may be necessary because of 2 reasons. One is because there has been error in the tax audit report. So this is definitely error on the part of auditor. And secondly, assessee is revising the figures in the financial statements, and that is why you are revising the report. So in both the cases, you can revise the returns, and the SRS you mentioned, what it requires is you have to make it conspicuously clear that this is a revised tax audit report. So any auditor or any reader should unmistakably understand that this is not the original, but this is a revised audit report. That is number one. Secondly, your audit report should state the reason for which it has been revised, so that reader should know this was the error. So supposing in case of intangible asset this year, you missed on weeding out goodwill for some reason or the other. Maybe it was purchased 10 years ago and the value was very minimal and it escaped your attention. But thereafter you realize, no, there was a goodwill of and some balance of 1 lakh rupees remaining, which was not significant. But even if it is not significant, we are reporting it as correct. So it is definitely not correct. Although the error is insignificant, it is incorrect. So maybe you can say that that particular aspect was missed out. In order to correct, the audit report has been revised. And thirdly, if the assessee is revising the figures in the accounts, then one will have to take a call why the figures in the accounts have been revised and whether that revision is appropriate. And then one has to consider revision in tax audit report. So there, this particular revision in accounts is necessarily married with the revised return being furnished by the assessee. In case of revised report is for the purpose if any error or omission has been noticed. So if it was error or omission, yes, you can revise the income tax return. For that, you may have to revise the accounts. But say in case of a promoter and builder, you were following completed contract method. That is, after completion and handing over possession of this particular apartments, or the possessions are apartments are ready for possession, you are recognizing the entire income. So you are following this policy, and then you realize that no, I will change the policy, and it is better to recognize it on progressive completion. So this is not error or omission. This is change of decision. So for change of decision, revised returns are not permissible. So in that case, auditor should refuse. So auditor should weigh between whether the revision is following error or omission, or revision is following change in decision. If the revision is following change in decision, to my mind, this particular aspect is that is revised. To say that okay, these are revised would be incorrect, because the revision is not following error or omission. The revision is following change in view on a particular matter. So in these cases, one will have to consider whether to issue revised tax audit report or not. In all cases, it may not be necessary also. But whenever there is occasion to issue revised tax audit report, these particular things should be mentioned. And just to give history, why this particular SRS was issued, because various companies claimed investment allowance. Pramod might remember. And the investment allowance provision said that 75% of the allowance you should make provision. You should debit to the profit and loss account and credit it to the investment allowance reserve. The companies which suffered loss, so there is no accounting concept of creating reserve out of loss. But then the Supreme Court judgment said that no, what the section says, you debit to profit and loss account, credit to reserve. So whether there is loss or profit, nothing is mentioned in the section. So if the investment allowance is disallowed, it's correctly disallowed. And then thereafter, those companies revised their accounts, debited profit and loss account even after loss, credited investment allowance reserve account, and then they were qualified for this particular allowance. So thereafter, the institute came out with this guidance. So in what circumstances you can issue revised tax audit report. So even for this auditing guidance, there is tax base.
Okay. No, very well, Chitra sir. Just one or 2 points to add on it. What we have talked about, what Abhay sir also asked, and you also replied on that, where the audit report is revised pursuant to SA 560, where the assessee revises his accounts, and then and then the audit report is revised pursuant to event happening after the balance sheet date or after the date of the audit. Now, and coming to the knowledge thereafter. Now, the issues which must be in the mind of the participants is that there is no revision of the financial statement. But what you said, there are certain errors while filling the form. Now, if I talk about the Income Tax Act and the rules therein, there is no explicit provision for revision of tax audit report until last 2 years. So, last 2 years, there was a provision brought in for the revision of the tax audit report, but which restricts the revision only for 2 points. First, where the disallowance was there under section 40A, I and IA, where the TDS was not paid before the due date of the filing of the return, but at the time of finalization of the audit report, but paid thereafter, because now there is a 1 month gap. So, but the tax was paid thereafter. So, before filing of the idea, the tax was paid, so expenditure was allowable. So, on that ground, you can revise the tax audit report. And second point is 43B. Up to the date of the tax audit report, that amount is not paid, and thereafter, before the filing of the ITR, you have paid. So, you can revise your tax audit report on the income tax portal and issue the due report. Now, in case there are errors or certain issues, though Income Tax Act does not allow it to revise, but the errors which we are rectifying on the income tax portal, they are taking it as a revision. And separate UDN is to be generated. Now, members should take care. This is a facility which they are allowing currently, but as per law, it is not there. So, कभी भी they can have a other view जब वो law से पढ़ना चालू करेंगे. So one has to be very careful about it. क्योंकि Income Tax Act तो revision का allow नहीं करता. So only these two cases. This is what I wanted to put.
No, only Pramod, my view on this two aspects of income tax department. What they say, I issued tax audit report on 25th of September. On maybe 25th of October, some TDS was paid or some tax was paid, and then they are allowing tax audit report revision. In fact, this revision is to suit their machine requirements, and this revision is incorrect because there is no error in my report. So why I should revise? On 25th of September, those were the disallowances. So really, they should have revised their program rather than telling us to revise the tax audit report. So even that revised tax audit report may be incorrect to my mind, because if it continues to be dated 25th September, if it is dated 25th October, fine.
In this case,
And just
in this, no, no, Chairman sir, in this case, the assessee would be after the auditor to revise the report.
yes. And just to complete the answer, we talked about before filing return, etc. After filing return, only this revision, if it is before the ITO noticing this error and after the ITO has noticed this error, is a significant difference. Because if ITO notices the error and then you rectify, maybe you will are in for the penal consequences. But before he notices you change, I feel that you can defend the bona fide of your own intention, and there was error which you noticed, and it will be really considered as error. But if ITO notices or the machine notices and points out and then you revise, I think whatever penal consequences are to follow for the assessee, for the auditor, I think they will follow.
Thank you so much, Titli sir, Pramod sir. I think we're almost touching 9 p.m. and we have time till 9. So just one or two questions. We've covered most of the questions, but I think just one or two last few questions we'll take. This is one question with respect to Pramod sir. If you could guide members on PF and ESIC, if the deduction is for the month of April, then it should be paid by 15th of May, irrespective of salary payment date. That is 30th April. There's one question. This relates to the month for which deduction relates. So now there is a clarification which member is asking that if to claim deduction for the month of April, then it should be paid by 15th, even if the salary is paid or not, in terms of the employee's deduction. Or if you could guide on that specific clause where employee contribution is there and it has to be deposited. I think there were issues and there were certain case laws which were there. So if you could just highlight or guide on this part.
Here, the question which the participant has asked is that salary is not paid for months. Say 2-3 months not paid. But the ESI and the PF, they are to be paid on a monthly basis after the deduction from the employee and the employer contribution thereof. So yes, the employee's contribution would not be allowed now after that clarification which has been added by the Finance Act 2021. So thereafter, even though the salary is not paid, but the deduction for the employee deduction and the employer deduction would have to be allowed. Employer would be by the due date before the due date of filing of the ITR if it is an employee if it is paid before the due date as per the ESI PF Act. So it is clear now that there is no relation of salary being paid and the ESI PF, the contribution. If Chitra sir has any other view, any more to add on this, you can just add.
No, there were judgments of Bombay High Court followed by other high courts in case of Hindustan Organics, Gule, etc., which stated that this particular disallowance, which springs from section 36, which says that employee's contribution, if paid on or before the due date, then only it will be allowed. If it is paid beyond due date, it will not be allowed. The judgment said that, okay, if not under 36, you claim under section 43B. There was some Supreme Court judgment as well. Now, to overcome that, the law has been amended, but it is really not amended, because the amendment does not say that, okay, whatever deduction which is allowed under section 36 will not be allowed under section 43B. They have issued a clarification. So when you clarify the law, right since the date of introduction of that particular law, this clarification is applicable. So even if it has come from this Finance Act 2022, it will also be applicable for earlier years. So if your earlier years, supposing you have claimed based on this particular case law certain deductions, the assessing officer may carry out rectification. by disallowing it, and to that extent he may be not be correct. So I think if it is noticed by the assessing officer for earlier years, you have disallowance.
Chitle sir, just to supplement out to you
Only
here.
I will see. So you will have to pay tax on it. But now, because of this disallowance, there also may be uh, interest under section 234BC because of shortfall of advance tax. So there we have a case law. In case of any change, if that change comes into effect after the due dates of advance tax, then in that case the interest cannot be made, because when the advance tax was paid, you were not aware of that law. So if supposing in 1920 employees contribution 1 crore rupees paid belatedly, still it is claimed. So I was not aware that that is the law. I was guided by High Court judgment, and High Court judgment is also law of the land as per Constitution. So I have followed that law. So I should not be extra penalized by way of interest. Penalty will obviously not attract.
No, Chitla sir, just wanted to supplement out here that in Delhi ITAT, plethora of judgments, and they are clubbing all the ESIPF prior to 1st April 2021 and saying that the memorandum says that it would be this amendment is to be made with effect from 1st April 2021. So taking that memorandum, more than 700, 800 cases has been held in the favor of assessing. That no addition. And for the old High Court decision, Delhi Emil, that would prevail. Just for the information of everyone. So in the Delhi jurisdiction, it is being allowed by the Delhi ITAT.
And if
Thank
there
you.
is any favorable judgment which does not follow the canons of law, I think assessee would gladly follow it.
Correct. Thank you, Chitta sir, and thank you, Pramod sir, for I think we've able to cover most of the issues, clarify for the in the best interest of members and the reporting requirement under Form CCD, and very practical, relevant discussions we had for I think last more than 1.5 hours. And thanks to you for sparing your valuable time, Pramodji, Chitta sir. And if still members have any issues which they have sent and have not been attended by us, would certainly request could send to dtc@icai.in for clarification. And I'm sure we would also initiate more programs in future, and we would have one-to-one interaction.
Abhay, we will take up those questions in subsequent programs. That would be better.
Correct.
So that everybody
Correct.
will know.
Yes, because Rudrakshi and Mukta both are here, and I'm sure whatever questions which are left, we'll ensure that those are attended and responded well in the subsequent programs. So thank you so much, both of you. Over to Chandrakant ji for his closing remarks. Thank you.
Yeah, thank you, sir. What to say? I would say I was attending, though my video was off, but I was one of the attendees here and listening to all the panel discussion that was going on. I would say rather saying that a topic was a practical aspect, I would say it was a critical aspects, which was really an eye opener for all of us, because most of the time whatever the discussion was being taken place, as far as the precautions to be taken, Pramod sir has said that when to file CA 3CB and 3CA, there is a lot of confusions regarding 50C, 43B, aggregate receipts, turnover issues. So this made me say that it was more of a critical nature rather than practical nature, and really the knowledge that was shared by CA Pramod Jain sir, or rather our own CCMCA Chitra sir also, it was really enrichment of knowledge, and the knowledge that they have shared is not to be measured actually, and it was full of everything that they had shared without keeping anything in their pocket, and they're sharing it all through the audience. And I really feel that all of you must agree that whatever discussions that we had today was really wonderful. And as CA Abhay Chhajad has said that we would like to have many more sessions. Even Chitra sir has agreed to share, and even I feel that we should have many more sessions, because these sessions will not only give the reporters more in a better way, and the image that we carry in front of the department will surely change their image, that what the chartered accountants are doing are much more better than what the image that they carry. So in the end, I would like to only highlight two things which sir has said in the beginning, that we should ensure that the financial statements which the institute is going to release through this committee in Excel, we should keep that in mind, and also the guidance note that they are going to release, we should get into it and read it properly and ensure that our reporting is being done in a proper way. With this the note, I would like to once again thank CA Pramod Jain sir, CA Chitre sir, and CA Abhay Chajad for their valuable time that they have spared with us, and the knowledge that they have shared for us year. And though we had been together for the last 2 years, 2 hours and 10 minutes, I hope they have given all the justice to our time rather than their time, and we would like to thank them for their valuable time and the knowledge they have shared. In the end, I would also like to thank our all the DTC staff who had been working to organize webinar, and at the same time coordinating and ensuring that whatever is coming to us through the virtual platform has been uninterrupted for the last 2 hours and 10 minutes. And so we would like to also thank them for their all support that they have given us to ensure that the webcast is going with uninterrupted. So with this note, I would like to thank all of you, all the participants who have been with us last 2 hours or so. Thank you, everybody. With this, we would like to close this session. Good night. Stay safe. Stay healthy. Thank you.
Thank you so much,
Thank
Chandrakantji.
you. Good
Thank you,
night.
Rudrakshi, and thank you, Mukta from DTC and from TQRB for having this very important webinar in the best interest of members. And thank you, Pramod sir, Chitle sir, and for your experience. Always add, in qualitative performance for each member when they prepare the tax audit. And Chandrakantji, for your time.
Yes, sir.
On behalf of both these committees. Thank you so much.
Thank
Thank
you,
you
sir.
all.
Thank you. Good night.
Thank you.